37% in a single day. No breaking news, no emergency announcement, no war, no pandemic, no bank failure, nothing. Silver opened Friday morning at $121 and was crushed to $75 before the market even had time to breathe. They called it a correction. They said markets got ahead of themselves, they told you it was healthy, normal. But nothing about what happened on Friday was normal. I watched it unfold in real time. The New York Open hits, and within seconds, massive institutional sell orders flood the market. Not retail traders, not profit takers. This was coordinated block-sized liquidation. Silver breaks 115, then 110, then slices through 100 like it never existed. Stops trigger. Margin calls explode. Forced selling cascades. By the close, silver is down 37%. 6 hours. Gone. That is not price discovery. That is not panic. That is execution. Here's what they won't tell you. The real event didn't happen on Friday. It happened weeks earlier, quietly, in the background, where nobody was paying attention. Margin requirements. In the 6 weeks leading up to the crash, the CME raised silver margins 4 separate times. December 12th, December 29th, December 30th, January 28th, 4 hikes. An 80% increase in required collateral. And the final change was the most important. They shifted from fixed margins to percentage-based margins, guaranteeing forced liquidation if price moved even slightly against leveraged traders. Margin isn't some technical footnote. It's the lifeline of futures trading. And when margins rise, every open position instantly needs more cash. Not next week, not tomorrow, immediately. And if you don't have it, your position is sold for you. No choice, no appeal. Imagine being told your rent just increased 80% and you have until tonight to pay or you re-out. That's what happened to silver traders across the entire system at the same time. Thousands couldn't meet the call, so the system sold for them all at once. And when forced selling hits at scale, price doesn't fall, it collapses. This isn't new. This exact playbook has already been used twice. In 1980, silver ran from $6 to nearly $50. The response? Margin bans, overnight rule changes, interest rates spiked to 20%, silver collapsed over 80%. In 2011, silver surged from 8 to 50 again. The CME raised margins 5 times in 9 days. Silver crashed 50% and took over a decade to recover. Now in 2026, silver ran from 26 to 121, the largest rally in modern history. And once again, margin hikes, forced liquidation, price destruction. 3 times in 50 years, same setup, same tool, same result. That's not coincidence, that's policy. So why does silver matter this much? Because silver isn't just a metal, it's a signal. When silver explodes higher, it exposes the weakness of the dollar. It tells the world that paper money is losing credibility. And that is a message the system cannot allow to spread. While paper traders were being liquidated on Friday, something very different was happening elsewhere. Shanghai vaults saw massive physical withdrawals. Not selling, delivery, metal leaving the system. China didn't panic, China bought. And that matters because China controls the majority of global silver refining. They control rare earth processing, gallium, lithium, cobalt, the materials that power modern technology, energy systems, and defense infrastructure. And earlier this year, China officially classified silver as a strategic resource. At the same time, central banks are dumping U.S. treasuries and buying gold at the fastest pace in decades. The dollar's share of global reserves just hit a 30-year low. Gold now represents a larger reserve asset than U.S. government debt. This isn't theory, it's happening in real time. And here's the most important part. Before the crash, physical silver was already unavailable, mints were halting sales, dealers were backlogged, premiums were exploding. At $121, you still couldn't get metal. Now spot says $75. Try buying it. The paper price fell, the physical market didn't, because paper silver and real silver are not the same thing. Paper can be created instantly. Paper can be margin called. Paper can be crushed with a rule change. Physical silver cannot. It cannot be printed. It cannot be liquidated out of your possession. It exists outside their system. They can control the screen price. They cannot control reality forever. Could silver go lower from here? Yes. Could it rebound violently? Also yes. Anyone claiming certainty right now is lying to you. But here's what's undeniable. Every time silver threatens the system, the same response appears. Rule changes, margin hikes, forced selling. You don't fight this hard against something that doesn't matter. Friday wasn't just a crash. It was a message, a reminder of who controls the paper markets. But it was also confirmation. Silver still threatens the system, even after 50 years of fiat money. They call it volatility. They call it risk management. I call it the same playbook running again. And now you've seen it. This is the hidden economy.